Here's a deep dive into the world of finance, covering the basics up to advanced topics. It's perfect if you want to quickly grasp key concepts before diving into specialized areas. Alright, let's get started. The finance and economics world is constantly changing, especially now. If you want to stay updated on everything happening in this industry, subscribe so you don't miss any updates. Here's a breakdown of the key elements and their interrelations, which will serve as a foundation for many of our future videos. Firstly, we have financial market indexes, which are the basis for many investments. We have major global indices, like the S&P 500, the Nasdaq 100, the Dow Jones Industrial Average, the FTSE 100, the DAX, and the Nikkei 225. These indices track changes in the value of a group of securities over time, reflecting overall market movements. Next up, we have exchange-traded funds, or ETFs, which are investment funds traded on stock exchanges. They allow investors to diversify their portfolios by investing in a wide range of securities with a single investment. ETFs have gained immense popularity worldwide because they offer several advantages over traditional mutual funds. They are typically more tax efficient, have lower fees, and are highly liquid and flexible. Some examples include SPY, QQQQ, TQQQ, SQQQ, and UVXY. Then there are exchange-traded notes, or although similar to their value is linked to an underlying index or asset, and they offer various investment strategies, including leveraged and inverse products. A few notable examples include VXX, GAZ, and MLPZ. When it comes to pricing these financial instruments, it's crucial to understand the mechanisms at play. For example, with ETFs, the price is calculated based on the net asset value, or NAV, which represents the per-share value of the fund's assets minus its liabilities. On the other hand, ETNs are priced using derivatives modeling techniques due to their complex structures. Several factors influence the pricing of both such as market conditions, interest rates, and the performance of the underlying assets. To make sure these financial instruments trade fairly, we have regulatory bodies like the SEC, CF, FTSE, SMA, IAB, IFSA, ABOE, and IOSCO that oversee securities and derivative markets globally. They work hard to ensure fair pricing, prevent market abuse, and protect investors. Now let's talk about leveraged shares, which are investment products that amplify the returns of an underlying asset, typically a single stock. These shares are created by financial institutions, but some are issued by companies like Leveraged Shares plc based in the UK. They use sophisticated techniques to provide investors with higher returns than the underlying stock. However, it's important to note that leveraged shares also magnify losses, making them riskier than traditional investments. Moving on to infrastructure, we have systems that help execute trades efficiently and accurately. ETF arbitrage systems use co-location and high-frequency trading engines to keep ETF prices aligned with their NAV. Meanwhile, quant engines leverage backtesting frameworks like Zipline or QuantConnect to develop and test factor-based investing strategies. And ETN risk engines integrate credit risk, volatility, and liquidity stress testing, often employing methods like Monte Carlo or value at risk, VAR, to assess risks in real time. Before we continue, quick question for you. What aspects of finance and economics are you most interested in? Let us know in the comments below. Alright, let's get back to the topic. To gain a deeper understanding of how these financial elements interact, let's explore two case studies that illustrate their impact. The first case study we'll discuss is the COVID crash of 2020. This event provided valuable insights into investor behavior and market dynamics during an unprecedented time. One significant aspect that stood out was the spike in demand for inverse volatility. Investors flocked to products like TVIX seeking to profit from a market downturn. However, the sudden surge in popularity caught regulators off guard. In response, the SEC stepped in and temporarily suspended several inverse volatility ETNs due to massive retail exposure and concerns about risk management practices. This case study highlights the importance of regulatory oversight and risk management in the face of extreme market conditions. It also underscores the need for investors to thoroughly understand the risks involved in complex financial products. Our second case study, the collapse of SVB in 2023, sheds light on the interconnectedness of the financial system and the impact it can have on specific financial instruments. SVB was a regional bank that collapsed after a series of missteps and regulatory failures. For ETN investors, this event had a profound effect. ETNs, tied to regional banks, experienced a sharp decline in value, with some losing approximately 90% of their net asset value. This dramatic drop highlighted the vulnerability of certain financial instruments to unexpected events. Regulators responded to this crisis by revaluing the maximum exposure limits for counterparty limits in each. This adjustment aimed to mitigate risks and provide investors with greater protection against similar events in the future. The case study serves as a reminder of the importance of diversification and the need for continuous monitoring of counterparty credit risk in one's portfolio. As we look ahead, Several trends are shaping the future of finance, including AI-driven portfolios, decentralized finance, DeFi, quantum finance, and synthetic ETFs. Each of these advancements presents unique opportunities and challenges for investors. Let's start with AI-driven portfolios. These portfolios leverage artificial intelligence to analyze vast amounts of data and identify profitable trading patterns or investment opportunities. By harnessing the power of AI, investors can potentially enhance their returns and manage risks more effectively. But it's essential to consider the ethical implications and potential biases in AI-driven decision-making. As we dive deeper into AI, we'll explore how it's transforming the finance industry. Next up is decentralized finance, DeFi, which utilizes blockchain technology to create a more open and transparent financial system. DeFi offers alternative investment opportunities and financial services without the need for intermediaries. It is important to understand the potential benefits and risks of DeFi and how it can impact traditional finance. Then there's quantum finance, which harnesses the principles of quantum mechanics to develop advanced financial models and algorithms. Quantum computing can revolutionize portfolio optimization, arbitrage, and the pricing of complex derivatives. However, the practical applications and challenges of implementing quantum finance are still being explored. Lastly, synthetic ETFs are gaining traction as an innovative investment vehicle. These ETFs use derivatives such as swaps or options to replicate the performance of an index or a set of assets. They offer investors exposure to markets that may be difficult to access otherwise. However, it's crucial to understand the complexities and risks associated with synthetic ETFs and their underlying derivatives. Each of these trends presents both opportunities and challenges for investors and the finance industry as a whole. By staying informed and adaptable, investors can position themselves to navigate the evolving financial landscape successfully. Now here's a sneak peek into our upcoming videos. We dive in deep into each of these trends, starting with AI and exploring how it is reshaping the finance industry. Don't miss out. Subscribe so you don't miss any updates. And just a heads up, we're constantly adding new material, so check back periodically to see what we've covered recently. Thanks for watching, and remember to like and share for more insightful content. Until next time, happy investing.